Hi, welcome back to this, my seventh data update for 2025. I know you're tired of these updates, and I'm tired too, but we're winding down towards the last couple. In this data update, I want to focus on something I haven't talked about so far. In all of the talk of market cap and risk, we haven't talked about the end game in business. What's the end game in business? Let me back up. I am in my third week of my corporate finance class, and for the first four sessions of the class, I haven't brought up a single number. And some of them, especially those who are not comfortable with numbers, have been lulled into a false sense of complacency. They think the rest of the class is going to be an extension of the corporate strategy class they took last semester. But in these four classes, I focused on what the end game for a business should be. I know there are lots of competing claims on what the end game is, but I believe that the end game for a business remains making money and creating more value. I know in this age of ESG and sustainability and stakeholder wealth maximization, I will be viewed, and I'm going to cement my moral troglodyte standing by saying this: the end game has to make money, has to be making money. You're saying, what about doing good for society? If you don't make money and increase your value, you're not going to be in a position to do good for society. So in this session, I'd like to focus on profitability around the world, how we measure profits, what the numbers look like, and how it varies across businesses, across sectors, across regions, and across the world. So let's start the process off by looking at profitability. I know that much as we dislike what accountants do, our raw data in valuation and corporate finance comes from accounting. I think they have a fixation on small details that gets in the way. And I've tried financial statement analysis classes, and often with financial statement analysis, I often end up more confused after I've computed 50 different ratios. I had no idea what the ratios were doing for me than I was before I computed the ratios. So about 20 years ago, I decided I had to create my own version of accounting. And in fact, there's a class on my webpage if you're interested with my version of what accounting should be. And in that class, I look at the financial statement that I use the most in valuation. It's the income statement. Let me take the income statement apart, and I'm going to use a very simplistic version of the income statement to set the stage. A business, if it's a non-financial service business, starts with revenues. We'll talk about financial service businesses like banks and insurance companies and investment banks later. But with non-financial service companies, you start with revenues. You get the revenues by selling your product or service, collecting a price, the revenues. From that, you subtract out cost of goods sold, or COGS as we end up calling it after an accounting class. What does that include? It includes the cost of the direct cost of producing the goods and services we're selling. You subtract the cost of goods sold from revenues, you get gross profit. From gross profit, you subtract other operating expenses. These are expenses you need for operations, but you can't directly tie them to the units you sell. It'll include things like R&D expenses if you're an accountant, because those are treated as operating expenses. SG&A, selling, general and administrative expenses, advertising expenses. You subtract those out, you come up with operating profit. From operating profit, you subtract out financial expenses, mostly interest expenses, but there are other versions of financial expenses that might show up. You subtract them out, and then you add in financial income. Where does that come from? If you have a cash balance, the interest income from the cash shows up here. And if you have holdings in other companies, the income from those holdings or losses show up here. So you net out financial expenses, you add in financial income, you come up with pre-tax profit. From pre-tax profit, you pay taxes. You come up with net profit. In fact, when you divide the taxes by the pre-tax profit, and remember, we're still working with an accrual income statement as devised by an accountant, we have the effective tax rate. You divide the net profit by the number of shares, you get the earnings per share. I think it's critical that when we talk about profit, we're very specific about which of these different versions we're talking about, because the drivers will vary for each version. In fact, as you move up the income statement, your versions of profit are getting broader. Let's start at the very bottom. You look at earnings per share, and you say, why would my earnings per share grow at a different rate than the net profit? The answer is in the math. It's because the number of shares might change. What causes the number of shares to change? In the US, as companies turn to buying back shares, that reduces the number of shares, or if you're a company that needs to grow by issuing shares, it's going to increase the number of shares. So the divide between net profit and earnings per share is going to come from share count. When you get from net profit to pre-tax profit, it's your taxes. If you can keep your effective tax rate low, that difference will be small. If the effective tax rate is high, the difference will be larger. As for financial expenses and financial income, those come primarily from how much you have as a net debt ratio. What's net? It's how much you owe in debt and how much cash you have, plus all the other investments you might have made as a company. So you've gone from pre-tax profit to operating profit. What would cause operating profit to be different from gross profit? You have these operating expenses, fixed operating expenses, and to the extent that they grow at a rate slower than the revenues, as your gross profit grows, your operating profit should grow at a faster rate. And finally, you get to gross profit, and you make the leap of cost of goods sold, you're at revenues. That's an income statement. I'm going to start with that and look at what companies around the world generated as income last year in 2024. So this is aggregated across all companies. I've converted all the numbers into US dollars so that I can add them together. So by sector, I start with revenues. So that's your starting point. And into 2024, publicly traded companies generated $61.1 trillion in revenues. Okay. On those $61 trillion in revenues, they generated about $17.8 trillion in gross profit. And 84% of companies had positive gross profits. I'm going to keep tabs on what percentage of companies are positive at each stage, and you'll see the numbers shift as you go from gross profit to EBITDA to pre-tax operating profit to net income. Collectively, companies also generated about $9.5 trillion in EBITDA, which becomes $6.3 trillion in pre-tax operating profit and $5.5 trillion net income. Notice that at each slice, you're leaving a slice behind because you're subtracting out expenses, factoring in taxes. And at each stage, the percentage of the companies that have positive income also shifts. Globally, 84% of companies had positive gross profit, 67% had positive EBITDA, 62% had positive operating profit, and 61% had net income. You're saying, why would I care? When you use a multiple, price earnings ratio, EV to EBITDA, one of the things to keep in mind as you look at that multiple is what percentage of companies you lose. With price earnings, because you're using net income, you're going to lose about 40% of your sample right off the top. Now, if you look across sectors to see if there are differences, there are, right? If you look at, for instance, net income, the giant in the room, the sector that delivers the largest net profit around the world, accounts for about maybe almost a third of total net profit, is financials. $1.9 trillion out of the $5.5 trillion in net profits around the world come from financials. When you look at the other measures of profits, operating profits, EBITDA, and gross profit, an interesting factor comes out. First, notice financials no longer show up. You're saying, why not? Revenues for financial, I'm not even sure what that would be. For a bank, is it the loans? Is it interest income from the loans? So revenue becomes fuzzy. Gross profit, again, cost of goods sold for a financial, I'm not sure what that is. In fact, you could argue that debt to a bank is like raw material. EBITDA and operating profit suffer from the same problem. If you get a chance, pick up a bank income statement and take a look, and you're going to see very unfamiliar items. It's a different structure. Now, if you look at gross profit, EBITDA, and pre-tax operating profit, another interesting thing pops out. If you remember, in an earlier session, we talked about the market cap of the different sectors. And the winner there, hands down, was technology. But technology is actually the third biggest group in terms of delivering profits. Industrials, old-fashioned companies, still are the second largest profit makers around the world. So that's absolute profits. And the problem with absolute profits is it's tough to compare across regions, across sectors, because it's not scaled to anything. Now, what did you scale it to? Well, there's an obvious metric right here in this table that you can scale it to. You can scale these profits to revenues, and when you do, you get margins. So in this page, what I've done is I've taken the income statement and computed different measures of profit margins. But rather than leave them out there with the definitions, I'm going to talk about what I think we can learn from each of these different metrics. Let's start with the gross margin. Remember the gross margin. I take my revenues, subtract out the cost of goods sold, the cost of making those products and services that I sell. To me, that is the best measure I can find in an accounting statement of unit economics. What's unit economics? It's what you make on that next unit you sell. Let's take two contrasting businesses. If you're a software company and you sell another piece of software, how much did it cost you to make that additional piece? Probably nothing. Your cost of goods sold is going to be tiny. Your gross margins are going to be high. In contrast, you can be the best manufacturing company in the world. But if you're an automobile company, to sell an automobile, you've got to make it so the gross margins are going to be lower. So look at gross margins to get a measure of unit economics, and changes in gross margins might tell you whether those unit economics are getting better or worse. Let's make a second stop. You're saying, what about operating margins? Well, what about them? First, notice operating margins are lower than gross margins. What drives the difference is those fixed operating expenses. Every business I ever talk to talks about economies of scale, and they act like it's automatically going to show up and push up their margins as they get bigger. But remember, economies of scale are not magic. What they capture are costs that grow at a lower rate than revenues. So if you have a lot of operating expenses that are fixed, in other words, your operating margin is much lower than your gross margin, that's a sign that you potentially could have economies of scale. Doesn't mean it's guaranteed, but as you scale up, perhaps you can have economies of scale. So operating margins tell us something about that difference between gross and operating margins tells us something about economies of scale. Now I'll make an intermediate tangential stop where I could look at EBITDA as a percentage of sales, an EBITDA margin. Saying, what does that tell me? If you compare the EBITDA margin to the EBIT margin, what separates it, at the risk of stating the obvious, is the DA, depreciation and amortization. If your EBITDA margins are much higher than your EBIT margins, you have a lot of depreciation and amortization, right? To me, that's a sign of capital intensity. Why? Because to depreciate something, you had to have that as capital expenditure in the first place. If you're a capital intensive business, the EBITDA margin compared to the operating margin will give you a measure of capital intensity. The difference between taxable income and the income after tax is your tax rate. So the tax drag you can get by looking at the operating income before taxes and then applying the effective tax rate of the operating income to see how much you left behind for the tax guy. And then, of course, net margin. Net margin is incredibly noisy. To me, it's the least useful measure of profit margin because in addition to everything we talked about, economies of scale, unit economics, capital intensity, it captures the effect of how much cash you have, how much debt you have, and all of the other stuff you might have accumulated in your balance sheet, holdings in other companies, financial investments. So when you're looking at margins, remember, not all margins are created equal. They tell you different stories, and you want to see what those stories are. So I'm going to try this by looking at companies around the world using different measures of margins. Let's start with gross margins. In this table, I've actually listed the 10 industries with the highest gross margins and the 10 industries with the lowest gross margins. Notice I give you two measures of margins, an aggregate margin and a median margin. You're saying, what's the difference? I've talked a little bit about this before in the previous session when I reported, when I computed multiples or ratios for different groups. I said, in an aggregate margin, I add up the gross income of every company in a particular industry group, including money-losing companies on a gross income basis, and I divide by revenues for every company. So that's the aggregated part. So think of it as a weighted average across all companies in the group. So there's no bias because you're not throwing companies out. I've also reported a median margin. Because of the way margins are distributed, averages tend to be skewed. The median is the middle of the distribution. For the most part, the two move together. So the rankings here are based on median margins. Remember, the highest median margin businesses have the best unit economics. There are a few electronics technology companies, and that's no surprise. You see software show up. You're saying, why is oil and gas showing up? Because while they might have lots of operating expenses, those operating expenses are often fixed. That additional, the additional barrel of oil you produce or gas that you sell costs you very little. The marginal cost is low. And you'll see a lot of infrastructure businesses show up as well as good unit economic businesses because the costs are all up front. What are the worst unit economic businesses? Business with the lowest gross margins. And I don't think there's a single surprise on this list, right? You've got a lot of manufacturing companies, steel, engineering. A lot of retailers often have to buy stuff from manufacturers, put a tiny margin on top and sell it. Food wholesalers, retail distributors. So really no surprises here, but at least you're getting. Again, let me be clear, you're looking at accounting numbers. There are other things that might affect gross income that you don't want in there. But I think it's a good start for unit economics. Next, I looked at the difference between gross and operating margins. Remember what I said, this gives you at least a sense of is the potential for economies of scale in your company. Because this difference is small, as you scale up, there's not much in terms of fixed cost you're going to be able to reduce, so your potential improvement in margins is going to be smaller. Again, let's look at the businesses with the biggest potential for economies of scale, with the widest difference. I'd be a little careful about the biotech sector because there are so many money-losing companies that difference is probably exaggerated. But because their costs are upfront in developing the drugs, I can understand. There are fixed costs. Those fixed costs, especially with things like R&D, which accountants still treat as operating expenses, is a potential. And you look down the list, the rest of the businesses again make sense. They tend to be businesses with large economies of scale. You know where this will play out. If you're valuing these companies and you're valuing a small company in these groups and you're letting this company get larger, you will feel this urge to improve margins because you've heard the economies of scale pitch. And in these companies, you have the basis for doing that because the difference between the gross and the operating margin is large enough. That suggests there are a lot of operating expenses, and perhaps if you can get them to grow, no guarantees, at a rate lower than revenues, you can benefit with higher margins. Then I looked at the industry groups with the smallest difference between gross and operating margins. And these are the businesses where there's not much potential for scale. And there is some bad news here. Many of the companies in the sector also have terrible unit economics. If you're a steel company, not only do you operate with really small margins, 13.88%, there's not much in terms of fixed costs to kind of benefit from reducing it. So when you talk about economies of scale with steel, you got to be careful how much you push the margins up. The margin will improve, but there's not much room to run. So collectively, when you look across companies, the difference in gross and operating margin gives you a sense of economies of scale. Finally, let's look at that EBITDA stopover. Remember, we said this is a measure of capital intensity if you compare the EBITDA margin to the operating margin. Big difference there would suggest that there is lots of capital intensity. I was a little surprised to see drugs on top, biotech on the top, because I don't think of depreciation as being a big line item for drug companies, whether they're biotech or pharma. But when I took a close look at the biotech companies, they had big amortization charges, parts of R&D being written off. So that's what's causing that. And since you're writing off R&D, which is in fact technically CapEx, I think it's fair to call them capital intensive businesses. The rest are pretty much infrastructure businesses, and it makes sense. I would expect them to show up on this list at the top of the list. If you look at the industry groups with the smallest difference, I was a little surprised to see real estate in the top until I looked at what was in brackets, operations and services. These are not real estate owners, but people who operate real estates for other people, for a fee, for a management charge. So I'm not surprised. It's not that capital intensive. Home building, again, could be capital intensive if you build the home and keep it in inventory and sell. But if you're just building homes for others, I can understand why it's not a very capital intensive business. So again, a few businesses here, you might say, I don't understand how this can be not capital intensive. But if you look at the depreciation charge, it's not large enough for me to put it in. So, make your own judgment as you go down this list, but most of those industry groups make sense. Now, I'm not even, as I said, net income is the least, net margin is the least useful, so I'm not even going to rank companies based on net margin. I've seen people use net margin a lot to talk about profitability. But if you're going to talk about profitability, maybe it's better to climb up the income statement. Now let's move on to accounting returns. What are we trying to do here? Rather than scaling profits to revenues, we scale profits to how much is invested in the company. And that raises the question, how do you measure that? In accounting terms, you measure it with book value of equity, we're looking at equity, or book value of invested capital, which is book value of equity plus debt minus cash. With book equity, the number you're going to focus on is net income. Dividing net income by book value of equity gives you return on equity, a rough measure of what equity invested in a company are earning on the equity invested in the company. With return on invested capital, your denominator is the book value of invested capital, book value of equity plus book value of debt minus cash. And in the numerator, you've got operating income, income to all invest in the company, but you get to keep what's after taxes. So you act like you pay taxes on the operating income, and that's your after-tax return on capital. Now, I'll confess to you that we're on dangerous ground with these accounting returns. Why? Because both the numerator and the denominator here are accounting numbers. The numerator is obviously an earnings number, comes from the income statement. The denominator is a balance sheet number, comes from the balance sheet. You're saying, so what? Choices that accountants make will affect your return on capital. And we'll talk about a few of those when I get to the measurement stage. Now, the follow-up to accounting returns is they give you a sense of what you're earning on your business and the capital invest. And the logical thing to do is to compare it to the cost you would require to earn the hurdle rate that we talked about in the last session. With return equity, you'd compare to the cost of equity and you get an excess return to equity investors. For return on capital, you compare to the cost of capital, and again, you got to compare apples to apples. You get an excess return on the capital invested in the business. So there, I can see the draw of accounting returns, and I can see why return on invested capital has become this magical number that people worship at. But having computed the return on capital for every publicly traded company at the start of 2025, just as I've done in previous years, I understand from the data all the potential dangers here. So I'll give you a sense of how I computed return on capital and some of the glitches I had to work through to get to a number that is even remotely reliable. For the numerator, I used the operating income from the most recent 12 months. I actually have another version I computed using an average operating income, but already you can see the danger here, right? If the company had a really bad last year, or really good last year, your return on capital is going to be skewed. For the tax rate, I used the effective tax rate the company paid during the last 12 months. For the book with operating income, I did make two corrections. One for leases, which for most part are being converted, are treated as debt now, but there are parts of the world they're not. If they were not, I brought it on and adjusted the operating income for leases. And I also converted R&D into a capital expenditure, which creates an asset which has to be depreciated. So my earnings before interest and tax or operating income is going to be different than the number you might see on Yahoo Finance or the financial statements of the company. But I think it better captures what the company is actually earning. My denominator, I start with the book values, book value of equity, book value of debt minus cash. And there are a couple of issues I'm going to run into. There are companies out there with negative book value. There are even companies with negative invested capital. And if that happens, the return on capital becomes not applicable. You can't compute it. Luckily, book value of equity is positive for most companies. You add debt, you subtract out cash, you get invested capital. But I complete the process by including leases as debt and the capitalized R&D as part of my book equity. And I do this for every company. So once I'm done with this, I have the returns on equity, returns on capital for every publicly traded company. Well, the logical next step is to compare to the cost of capital, which I have for each of the companies as well. What am I trying to figure out? I'm trying to figure out what percentage of companies earn more than the cost of capital, what percentage earn less than the cost of capital. You're saying, why does that matter? Well, I've capital invest in a company. If I don't earn at least the cost of capital, I'm not creating value. Making money is not enough of a test. You have to make enough money to cover what you could have done with that capital. So what I did was I took all publicly traded firms, broke them down by sector, and started with return on equity versus cost of equity. So let's take communication services. The return on equity, I'm now stick with medians here because they're easy to work with. The median return on equity for communication services was 3.57%. The median cost of equity was 10.92%. The median return equity minus cost of equity. So the reason that's different from just dividing and subtracting out the cost of equity from ROE is I compute that excess return for each company, and this is the median. Minus 6.67%, the median communication service company delivered a return equity 6.7% less than its cost of equity. And only 30% of communication services companies delivered returns in equity that exceeded the cost of equity. You can see the statistics with return capital. I did that again with each sector. With financial services, I do only return equity and cost of equity for the reasons I talked about earlier. Debt to a bank is raw material, it's not capital. I think it's nonsensical to talk about the return on capital for a bank or a cost of capital, so I'm going to stick with return equity and cost of equity. There isn't a single sector when you look across all publicly traded firms, or forget about 50%, where even 40% of the firms earn more than the required return, earn more than the hurdle rate. Globally, about 30% of all firms earn a return on capital that exceeds the cost of capital, 70% lag. Now, one reason for that in all publicly traded firms is you do have a significant number of money-losing companies. And obviously, a money-losing company, given how I've computed accounting returns, will have a negative return on equity and a negative return on capital, which already puts them underwater. You know, compared to the cost of equity or capital, you're going to get a negative excess return. So I followed up by looking at only firms with positive operating income. This way, you can't complain that I've included the money losers. Even if you look at only money-making firms, you basically hit 50%. Some sectors it's 55. I think if you look across outliers, really nothing jumps out and say 90% of the companies earn more than the cost of capital. Even among money-making companies, about half earn more than the cost of capital. The other half earn less. Making money might be easy. Creating value is incredibly difficult. So what next? I took the sectors which are broad and broke them down into industries. And then I ranked the industries, I have 93 of them, from highest spread in return on capital versus cost of capital to the lowest. I know it's simplistic, but here's what I did. I took the 10 industry groups which had the most negative excess returns, return on invested capital being lower than the cost of capital, and I'm going to call them my bad businesses. Already with that list, you can see the weakness of my categorization. Biotech looks like it's a worse business, but part of the reason is it's young. There are a lot of money-losing companies. But some of the others have been in this list for a long time. So there are bad businesses. At the other extreme, I looked at the industries with the most positive excess returns, earn the most over their cost of capital. These become good businesses. Now, if you're an ESG person, you might want to look away. The very best business in terms of earning a spread over the cost of capital is the tobacco business, earns 7.41%. More than the cost of capital. Utilities barely break even, but this is the list of the 10 industries which earn the most over the cost of capital. So take it for what it's worth. You might refine this list if you have a chance by looking at perhaps 10-year average returns on capital. Maybe that'll give you a better result. I've tried multiple versions of it. In every single version, it's tough to find businesses that can earn more than their cost of capital on a consistent basis. I also looked at excess returns by region, breaking them down into the regions. You're by now familiar with my breakdown of sub-regions, where I looked at what I was trying to look at is, are some parts of the world easier to operate in than other parts of the world? And does it show up in the returns? Again, I see very little evidence of this. Around the world, you see the same problem. Well, obviously, Canada and Australia have problems of their own. They always seem to come in at the bottom of the list with the fewest percentage of companies earning more than the cost of capital. It's, I think, the fact that there are a lot of natural resource companies. It's both markets are heavily concentrated in natural resources. Maybe that explains this. But around the world, you see it's tough to find any part of the world where you see significant percentages of companies earn more than the cost of capital. In fact, Japan might be the best region of the world in terms of if you look at all publicly traded firms, with about 45% of companies earning more than the cost of capital. As before, I looked at only companies that make money because I think it's a kind of a looser test. And there you get about 50% of companies making more than their cost of capital. The US has one of the higher numbers at 64%. But nothing, no region of the world do you see 80, 90% of companies earning more than their cost of capital. So as you look at all of these, you're saying, what now? I think as I look at these numbers, there are three things that come to me. First is, making money itself is, it's good to make money than to lose money. Don't get me wrong, but making money is not a sign that you've arrived, that you're successful, because you have to make enough money to cover what the capital you've invested in your business could have earned elsewhere. That's what a hurdle rate is. And what these tables, what these data suggest, it's much more difficult for companies to create value than it is to make money. Second, a legendary lawyer, Marty Lipton, and he was one of those lawyers who stood against activist investors. And I remember listening to him in a debate saying, why do we need these activist investors? Most managers are good. Most managers run their firms well. And my reaction was, Marty, you need to look at the data. And if Marty had looked at the data, maybe he'd have changed his mind, because as you look at this data, there's clearly no evidence that for the typical company, managers are doing a good job. 70% of companies globally earn less than their cost of capital, and cuts across the world. So if there's an argument to be made for corporate governance, that table alone should do it. We need corporate governance because many companies are suboptimally run and need to be fixed. Finally, we think of companies as these incredible profit machines. You can keep asking them to do things. I've used the fatted calf description deliberately, because there are at least two groups that have picked on companies. Politicians, of course, argue that companies are price gouging and incredibly profitable, and the way to bring inflation down is to get companies to cut prices. And you also have the virtue crowd, ESG, sustainability, stakeholder world, say, look, companies have so much money. Why can't they take care of other stakeholders? Implicit with both these groups is the belief that companies somehow are incredibly profitable, have all this excess profits to give away. It may be true for some companies, but for most companies, that's definitely not the case. Taking a company that's already earning less than its cost of capital and adding to its list of things you want it to do, it's a recipe for putting it into bankruptcy or putting it into real trouble. Now, a few months ago, and this is the final thing I want to say, I was asked by a parliamentary committee in Canada to come in front of the committee to provide testimony. And I said, I'll do it if I don't have to fly to Canada. And they gave me a Zoom link, and I showed up. And this was a committee that was writing laws for banks, and they were thinking about writing a law that would explicitly make Canadian banks lend less to fossil fuel companies and lend more to green energy companies. It's actually an idea that's gotten traction in the EU and seems like a great idea. And every person on that panel who is pushing for this change seemed to believe that banks had a lot of profits, and that pushing them to go out and lend less to fossil fuel companies and lend more to green energy companies was the right thing to do. But are Canadian banks that healthy? So when I took a look at Canadian banks, and you know what? 2/3 of Canadian banks earn less than their cost of equity. Remember, with banks, you stay with return equity and cost of equity. The median return equity for a Canadian bank is about 8%, barely above its cost of equity. You take a Canadian bank and you ask it to lend less money to its most credit-worthy customers. Fossil fuel companies often have the most cash flow, they're most able to service debt, and lend more money to their least credit-worthy customers. You're saying, so what? Let the shareholders in the banks bear the burden. The shareholders in banks are a tiny slice of banks. You know who's going to end up bearing the burden, right? It's depositors. You're going to get depositor money at risk, and it's a disastrous policy. So wherever you see people say companies have lots of money, pause the conversation. Companies are holding other people's money. You want to take that money away from a stakeholder, whether it's shareholders, lenders, employees. Be clear about where the money's coming from. It's not coming from IBM or Apple or Microsoft as a company. So as you look at the data on profitability, I hope it makes you rethink what the conventional wisdom is on companies getting more profitable and generating more earnings over time. I think it's actually more difficult to run a business now than it was 20 or 30 years ago. and globalization and disruption have made it so. And the data, I think, backs that up. I hope you found this session useful, and I thank you very much for listening.